Hello friends, James Stevenson back with part 19 of my 2022 Q4 Tesla earnings forecast video review series. I am joined as always by my uh, boisterous host, Loki the Chihuahua, who is napping in bed. So let me share my desktop and pick up right where we just left off. We talked about PEG ratio in the previous video and how the calculations in my forecast model work. So which columns do I want to show? I think I want to show 2022 and 2023, with Q4 being the first forecast to go quarter on the page. So, those are actuals, and Q4 through the end of 2023, those are my forecasts, and I just lost my place. So I'll scroll right back to where we were. Luckily, I have the PEG ratio to use as a milestone for me. Okay, so we know what our GAAP net income is. That was the result at the bottom of our income statement. How do you get to Adjusted EBITDA from there? What are the adjustments that you make? If you want to know what the Adjusted EBITDA is, by doing the calculations yourself instead of just taking the word of Tesla when they report this number on their investor letter. So I'll show you. It's just a couple of adjustments here. You need to add back interest expense, the provision for income taxes, the depreciation, amortization, and impairment, and the stock-based compensation expense. Those are the adjustments that get you to the Adjusted EBITDA non-GAAP. So what's this formula doing? It's taking the sum of these items. So what does EBITDA stand for anyway? It stands for earnings before interest, taxes, depreciation, and amortization. What does before mean in that acronym? It means you have to back them out. So if 5.133 includes those items, so if the 5.133 billion worth of GAAP net income is after you've accounted for those expenses, then to get what it was before, you have to back those items out. So that's what this sum is doing. It's saying, hey, I know what each of those items were because they've been reported higher on the page in the income statement section. The interest expense, the taxes, the depreciation, amortization, and impairment gets reported separately, and I have to adjust for the actuals every quarter. And I'm just forecasting Q4s based on looking at the average of the trailing 4 quarters and growing that by 16.3%, which is a pretty decent multiple to use. Tesla has a lot of new factories, and the depreciation is highest early in the life of those assets because there's going to be a mix of 3-year, 5-year, 7-year, 10-year, 20-year depreciation lives on those, with the weighting being towards early in the life of those factories. So you have more depreciation expense early in the life of your factory and less per year late in the life of that factory, unless you do a lot of reinvesting in the factory. So that's why the multiple is so high there. Tesla's got Giga Austin and Giga Berlin and Giga Shanghai all seeing significant capital investments recently. So that's what's behind that forecast. And that's how I get to my Adjusted EBITDA forecast of $6.2 billion. That's a bunch. With an all-time record, well, maybe not an all-time record. In Q1 it was 26.8. Was there another one this high? I don't see another one. So nearly a record, if not for that one quarter worth of EBITDA. And then next year I'm forecasting big time record growth in Adjusted EBITDA. All right. So below that, I've got the automotive gross margin percent in total. I've got the regulatory credits as a percent of revenue. And I've got the automotive gross margin excluding regulatory credits. So sometimes you'll still see Tesla haters out there saying Tesla only makes money because of regulatory credits. Well, that would be true if Tesla's total profit margin was only 1.1 or 1.2%. Last quarter, as reported, it was 1.1% of revenue. So if Tesla's profits were 1.1% or less of revenue, then they'd be right. But Tesla's profits are way, way more than 1% of revenue. So they're not correct, and you can show them the real numbers if you want to set them straight. So this is a good number to look at. What would the automotive gross margin be if regulatory credits did not exist? I'm forecasting that number lower in Q4 as a result of some lower pricing and some promotional offers in China and in the US, especially in Q4. But for that to bounce back in future quarters with people spending more on Teslas as the overall cost of producing vehicles continues to decline for Tesla as they ramp up the factories in Berlin and Austin, and as Shanghai hits higher production levels. The cost per vehicle, the weighted average cost per vehicle ought to be improving as Fremont, with its California labor rates, becomes less and less of the total automotive cost pie. All right, that is my video for today. I will end the video there and say if you've enjoyed today's video, click the like button. If you're not subscribed to my channel, why not go ahead and subscribe to my channel over here and click the alert bell to get notified when I publish fresh content. Thank you to anyone who supports me with attaboys or likes or comments. All of those help the YouTube algorithm recommend my video. But especially to those who support me through Patreon or by joining my YouTube channel, in particular my executive producers Kathy Kishler and Halter Ferguson Financial, and I'll see you in the next one.